Did you know that recently investor Cathie Wood gave a huge warning about the financial industry? Based on experience and thoroughly studied data, Wood's words are worth heeding. You definitely would not want to miss what she said. We believe the Fed has been making a mistake, a policy mistake. We are getting all kinds of catalysts, which should give the Fed a pause, Cathie Wood said. If not a pause, it should cause an entire pivot and reversal in policy. They are making a mistake. The markets are telling us that they are making a mistake. I think something will break that matters to them if they keep following the lagging indicator called the CPI. Cathie Wood is an American investor, a star stock picker, and the founder, CEO, and CIO of ARK Invest, a company with $60 billion in assets that invest in innovations like self-driving cars and genomics. Cathie Wood is often called the most underrated investor in the game, since not only is she incredibly persuasive in her investment arguments, but she's also got the proven results to back up her surprisingly discerning claims. Cathie Wood provides monthly updates about several things like monetary and economic policies, innovations, what can be expected in her field of expertise, and comments on the Fed's decisions. The Federal Reserve System, commonly known as the Fed, is the central bank of the U.S., which regulates the U.S. monetary and financial system. In June, the Fed raised rates by 75 basis points to a range of 1.5 to 1.75%, the most significant one-time hike since 1994. And later in July, it is expected to raise rates by another 75 basis points, with one CME FedWatch tool pricing the probability of that happening at 90.6%. Wood sees this move as a mistake. Wood argued that the Fed should be worried about deflationary forces. There are all kinds of deflationary signals which are going to force the Fed, we think, to pivot and reverse its policy. Wood noted, the deflationary signals include trading patterns of gold, the US dollar, yields, oil, and copper. Often viewed as an inflationary hedge, gold has tumbled below the $1,723 an ounce level, down around 12% in the past several months. This trading pattern does not support the inflation narrative, Wood pointed out. In late June, Cathie Wood warned that the US is already in a recession. ARK Invest CEO Cathie Wood admitted during an interview with CNBC that she had underestimated the severity of inflation and proceeded to claim that the U.S. economy is likely already in a recession. Wood blamed supply chain disruptions and geopolitical factors like the war in Ukraine for exacerbating inflationary pressures beyond what she had anticipated. She also said that a recession, driven in part by mismanaged inventories, had already begun. During an interview with CNBC's Andrew Ross Sorkin, Wood said, "We think we are in a recession. We think a big problem out there is inventories, the increase of which I've never seen this large in my career. I've been around for 45 years. The innovation-focused investor said inflation has turned out to be hotter than expected due to supply chain disruptions and geopolitical risks." Wood explained that supply chain issues had led major retailers to mismanage their inventories, leading to a glut of certain finished goods, like furniture, that was in high demand during the pandemic. She said that even the best-managed companies in the world are having problems. She added that the surge in inventories seen over the past year has been larger than anything she has seen during her 45-year career. According to Wood, inflation is still a short-term problem. This becomes clear when investors start paying closer attention to how gold, the US dollar, and yields have been trading, Wood said in early July. Wood said that gold has been one of the most reliable inflation gauges out there, and that it has broken down to the low end of its range. That will confirm in my mind that deflation is the greater risk here, not inflation, Wood stated when talking about gold prices. She added that the latest dollar strength is even a bigger sign of deflation, noting that the US dollar index is trading at 20-year highs. Moreover, the 10-year Treasury yield is still below 3%, and oil is down more than 20% on the month. Even oil is starting to break despite what's going on in Russia because the global economy is in recession. So demand has not gone higher than 2019 levels. It is supply that has been hit. Now at $96, oil is down 22% on a month-to-month basis, she pointed out. Copper is another example, with the metal acting as a gauge of real activity and inflation. Wood explained that all these things point to the inflation problem as overblown. If we are right and inflation unwinds pretty dramatically during the next 6 months, that should help growth, Wood said. We were strong on one thing, and that was inflation being as sustained as it has been. Wood said, "Supply chain can't believe it's taking more than 2 years in Russia's invasion of Ukraine. Of course, we couldn't have seen that. Inflation has been a bigger problem, but it has set us up for deflation." To understand better, a recession is a business cycle contraction when there is a general decline in economic activity. It is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. Recessions generally occur when there is a widespread drop in spending. Inflation is the rate of increase in prices over a given period. Inflation is typically a broad measure, such as the overall increase in prices or the increase in cost of living in a country. Deflation, on the other hand, is a decrease in the general price level of goods and services, which occurs when the inflation rate falls below 0%. Inflation reduces the value of currency over time, but sudden deflation increases it. In a recent interview, Wood said, "We know that innovation in the public equity markets, not the private equity markets, has been ravaged in the last year. It's been about a year that it has been ravaged." And Raul mentioned that when there was a change in expectations, the thought that the economy would open up and interest rates would go up, inflation would go up, but would be tamed. Last year, despite the change, the supply chain issues did not go away. That said, the fear about what inflation and interest rates are going to do has gripped the innovation space at first, and now it seems to be affecting the market a little more broadly. Wood said, "I think the fears here are going to shift from rising interest rates and higher inflation, potentially to recession especially. And you've heard me on this before because we've seen inventories piling up throughout the ecosystem." According to Wood, innovation stocks in the public equity markets are down to 50% from 75% in the last year. While other investors worry that the U.S. could face a recession next year, ARK Investment Management founder Cathie Wood thinks one already has hit and that it could be over next year. While many economists and strategists have been resisting the notion that we are in a recession and anticipate that the U.S. may enter one next year, we actually think we'll be coming out of it in 2023, said Wood. Like Wood, Wharton School of Business professor Jeremy Siegel agrees that the U.S. is already in the middle of a recession. Siegel told CNBC the economy likely contracted in the first half of the year. "I think we're actually in a mild recession." He added that indicators he is watching point to the economic slowdown into the third quarter. In particular, he said data on the U.S. money supply has declined, suggesting we are getting a handle on inflation. Wood explained that they are starting to get a lot of indicators that prices are coming down, and she thinks that the inflation that everyone has been worried about is the wrong way of looking at the world right now. She emphasized their belief that deflation is the bigger risk. "We believe that deflation is a much bigger risk," says Wood. She added that they have been saying this for a time. Wood said that they have been ridiculed for saying so and were even challenged by those who were sure that the U.S. is into a 70s-style inflation scenario. Amidst concerns, most believe that a recession does not seem to hurt Tesla meaningfully. While automotive players typically see sales plummet through economic downturns, Tesla's business is expected to hold up much better. EV adoption is still in the very early stages, and demand has generally been outstripping supply for Tesla. Tesla has previously guided for over 50% delivery growth over a multi-year period, while indicating that it could approach 60% growth this year, which signals that demand growth should hold up even in the event of a downturn. Make sure to subscribe to this channel to be updated on warnings from experts like investor Cathie Wood.